Sharing that. And can you guys see the screen with the PDF slides and the whiteboard?
Yes.
Okay.
Yeah.
Yes.
So it's about time to get started. Before we start for today's lecture, let me just go over some housekeeping items. So I realized that some of the students has been emailing to an email address that does not belong to mine. So apparently some students use baruchmail.cuny.edu, which is a student email account at Baruch College. So in order to email me as a professor, you have to use baruch.cuny.edu. So if there are any students who send an email to me, hopefully that I get it using baruchmail.cuny.edu. Unfortunately, I couldn't get it. So make sure that you use this email address, DAEUNLEE at baruch.cuny.edu. Okay? It's not baruchmail.cuny.edu.
Does he forward it to you or not?
No. So that's why it's very important that you use baruch.cuny.edu in order to reach me. Okay? Another thing that I want you to go over is this. So some of the students are actually prefer this textbook version instead of digital version of textbooks to go over the course materials. So, and then some students has been asking me whether you guys can get the solutions manual to for brief exercises, and practice problems that are in your textbook. So here you go. If you go to course document, textbook solutions, I posted all the solutions manual for the chapters they will be covering for this semester. So if you prefer textbook version and then practice using some of the practice questions in the textbook, you can certainly go into my Blackboard and download all the solutions manuals, okay? But if you actually prefer digital version, you can find most of the textbook questions under, hold on, load it up, please. So here, so chapter 1 textbook questions, chapter 2 textbook questions. So these categories contain all the, not all, but most of the practice questions that are in the textbook. So if you prefer digital version, you can go into my Connect in order to practice. But if you prefer textbook, you can certainly do that. And then I posted the solutions manuals as well. And then, so that's a housekeeping item. Any questions before we get into today's lecture? I guess not. Okay, so let's get started for today's lecture. Also, I activated this chat function. So if you prefer to ask questions by typing, you can certainly type your questions. But of course, you can just interrupt me in the middle of my lecture to ask questions using your webcam or microphone, okay? So let's just review what we discussed last time. So we talked about this accounting is very important for third-party outside users, and two of the reasons why we study accounting is to measure the business transactions and communicate those business transactions with the third-party users of the financial statements. And then one of the biggest lessons that we learned from last time is this equation: assets equals liability plus shareholders' equity. This accounting equation is very important, something that you have to keep in mind all the time throughout the semester, okay? And another thing that we learned last time is this equation: net income equals revenue minus expenses, okay? So as long as you remember these two from last time, you are in pretty much in good shape, okay? So let's just try practicing some of the questions that I got from the publisher. So can everybody see the PowerPoint slides? That starts with each of the following independent. Okay.
You're still looking at the review question slide.
I couldn't hear you. Your voice is sort of.
Sorry. On my screen is still the review questions.
It's a review question. Oh yeah, that's good. Yeah, that's what we're doing.
Okay.
Yeah. Okay. So let's start with this. Each of the following independent situations represents amounts shown in the 4 basic financial statements. Fill in the formulas and missing blanks using your knowledge of amounts that appear on the financial statements. So number 1, revenues equal $27,000, expenses equal $18,000. So net income should be very easy, right? $9,000. $9,000. So let me just write it down. Revenue equals 27 K, expenses equal 18K. So at the end of the year, net income equals 9K or $9,000. Very easy stuff. So let's go to number 2. So number 2, increase in stockholders' equity is by $70,000. Issuance of common stock is $11,000. Net income is $12,000. The question is asking what's the amount for dividends, okay?
6,000.
So let's just go down a little bit. I practiced this. So it says, according to the question, so there was an increase in stockholders' equity by $17,000. And according to our formula, shareholders' equity equals retained earnings plus common stock. And this retained earnings include net income minus dividends, okay? So at the end of the day, so shareholders' equity actually equals to net income minus dividends plus common stock. Okay, so the fact that the shareholders' equity increased by 17K, we have the net income, which is equal to 12K, and the common stock issued was $11,000. And of course, we don't know the exact amount for dividends. So this is a simple math. So we're gonna flip that into the other side. We're gonna bring 17 on the other side. So X equals to 12K plus 11K minus 17K. So that equals to, let me see, 23, 6K, okay? So the answer is $6,000, okay? And stop me if you are confused with anything else, if you are just not sure about anything, okay? Number 3, assets equal 24K, stockholders' equity equals 15K. The question is asking liabilities, so very simple stuff. We know this accounting equation. So number 3 says assets 24K. We don't know liability plus shareholders' equity 15K. So of course, X is 9K. So we have $9,000 of liability. Okay, so pretty much easy for chapter 1. So there's not many tweaks or twists that we can do with respect to chapter 1. But as we move forward with chapter 2, 3, and 4, there are a lot of confusions that will arise during when you solve questions. Okay. So number 4, total change in cash is $26,000. Net operating cash flows, 34K. Net investing cash flows is 17K, but in parentheses. So I want to go over just one thing. So in accounting, when we want to indicate negative values, you can certainly use negative 17K in order to indicate that you are referring to negative number. But in accounting, actually, we use parentheses to indicate that this number is in negative, okay? So this is something that we just had the accounting field or accounting society has agreed upon to indicate that the numbers in negatives, let's just use the parentheses to indicate that, okay? So, and then net financing cash flow. So this is the finance of the with respect to the statement of cash flows. So according to the question, the change in cash was 26, okay? That's total. So we have operating cash flows of 34. We have investing cash flows of negative 17. The question is asking, what about financing cash flows of X amount? Okay, so that's very easy stuff. So again, 26 equals 34 minus 17 plus X. X equals to, let me do the math. So that's 17. So that's 9,000. Okay, so we have a net financing cash flows of $9,000 for this year. Okay, any questions so far? Okay, good. Very good. Number 2. So the company has the following account balances at the end of the year. So we have equipment, accounts payable, sellers expenses, common stock. So the question is asking, use only the appropriate accounts to prepare a balance sheet, okay? So I don't know whether I can draw something here. Now it works, okay. So what you need to do for this chapter and going forward is to be able to identify which accounting item goes to either balance sheet or income statement. Okay, so for example, equipment is an asset, so that should be indicated, or that should fall under balance sheet item. So this is a balance sheet item. Accounts payable is another balance sheet item. So that's a liability that's reported under liability section. Seller's expense. So it's an expense, so it will be reported under income statement. Common stock is a balance sheet item. Land is a balance sheet item. Notes payable is balance sheet item. Service revenue. So revenue should be reported under income statement. Cash is a balance sheet item. Retained earnings is a balance sheet item, but it also it is also reported under the shareholders' equity statement. So again, so use only the appropriate accounts to prepare a balance sheet. So in order to prepare a balance sheet, we're not going to use service revenue. We're not going to use sellers' expenses to prepare a balance sheet. We are only going to use these items that I just indicated. So one of your goals should be for this course is to be able to prepare a balance sheet as well as an income statement. So let's try to prepare a balance sheet. Okay. So usually balance sheet has in 3 sections. So we have an asset category, we have a liability category, and we have a shareholders equity category. Okay. So let's just start preparing. So asset equipment. So we have an equipment at $26,000. Okay. So this is an equipment. Accounts payable, it's a liability item, so we're going to report it under liability section. So accounts payable by $3,000. Common stock is a shareholders equity item, so you report common stock for $11,000. Land is an asset, so you report land under asset category by $18,000. Notes payable is a liability item, so notes payable right here, 20K. And we have cash here. So cash is reported under asset by $6,000. Retained earnings is reported by, we don't know, X amount, okay? So this is one tweak that we can do. And like I said previously, all these accounting equations should hold all the time. So let's try to find out what the number is for retained earnings. So we have 26K, 18K, 6K for assets. So that totals equals to 50K. Okay, so that's 50K of an asset that's reported for that particular company equals liability. We have $23,000 plus we have $11,000 plus X amount. So in order to solve for X, so that's 27, that's 27, okay. So that's 16, okay, 16K. Simple math. So instead of reporting X, we report $16,000 under retained earnings. So this is the balance sheet. Of course, it looks messy and ugly because I'm handwriting it, but if you use an Excel or a PowerPoint, you can make it fancy and pretty. But this is essentially what the balance sheet is. So under balance sheet, you have an asset section, you have a liability and shareholders' equity. Make sure that the total amount of an asset equals to the sum of liability and shareholders' equity, okay? So any questions with respect to preparing a balance sheet? Okay, I think we're pretty much in good shape. Let's go to next question. So, there you go. On December 31st, 2021, this company reports the following revenues and expenses. In addition, the balance of common stock at the beginning of the year was 200K, and the balance of retained earnings was 32K. During the year, the company issued additional shares of common stock for 25K and paid dividends. Prepare an income statement. So let's start by constructing an income statement for this year, for the year 2021 for the particular company. So income statement, like I said previously, it relates to revenues and expenses, okay? So let me just indicate this. So we have revenue, we have postage expense, legal fees expense, rent expense, salaries expense, and supplies expense. So we only have one revenue, but we report 5 different types of expenses. So let's prepare an income statement. So income statement usually starts with revenue. So it reports service revenue by $75,000, okay? And there are expenses that are reported. So under expenses, we have postage expenses by 1.5K, legal fees expenses by 2.4K, rent expenses by 10.6K, salaries expenses 24K, and last item is supplies expenses by 14.5K. So total expenses is, oh, let me just do the math. So 3.9, 10.6, okay, 24, 14.5,
53.
okay, 53. Very good. Someone is very good at math here. So that's 53K. So at the end of the year, the company will report a net income of, I don't want to use this equation mark here, of 22K. Okay, so this is an income statement. So you start with a revenue and you report all sort of expenses and you total or sum all the expenses. And in the last line, or at the end of the day, you report either a net income or a net loss by the respective amount. Okay, again, this income statement looks very ugly because my handwriting is ugly. But if you use an Excel or any third-party programs, it will look very pretty, okay? So this is an income statement. So this is what we learned from last time. So again, in order to review what we learned last time, always remember the accounting equation, which was asset equals the sum of liability and shareholders' equity. You have to understand each accounting line items, such as the service revenue, postage expenses, or accounts payable, accounts receivables. And you also have to be able to prepare a balance sheet or and the income statement, okay? And I can tell you that during the midterm, there will be a question that asks you to prepare either an income statement or a balance sheet, okay? Any questions?
Hi,
Yeah.
this is Yufan. I do have a quick question.
Sure.
When we doing the either the test or regular homework, do we have to list these items according to the liquidity?
According to the liquidity, yes. Yes or no? Let me see. So, let me.
Because like a cash, it should be all in
Yeah,
now.
always on the top. I don't think so, but the question will specify whether this item, it falls under current asset, for example, current asset or long-term asset. But I have to double check on that. But thanks for asking. Whether the system, this internet, that's what we call it, the macro hill system also recognizes the accounting items by liquidity. I'm not sure. I'll double check on that.
Okay, thank you. I appreciate
No
it.
problem. Any other questions? Okay, I think we're good. So let's start with chapter 2. So for this chapter, we're going to be focusing on journal entries. Now, what I mean by journal entries is that for each particular transaction, there are ways that the accounting professionals record on their company's books. So we talk about, again, accounts payables, accounts receivables, cash, or prepaid expenses, prepaid insurance, whether these accounting items are debited or credited, and then by what amount that we report for each particular transaction. That's the whole focus of this chapter 2. So let me just talk about some of the things that are very important before we get into chapter 2. So again, we have assets equals liability plus shareholders equity. Okay, this is the number one accounting equation that you guys have to memorize. Now, under shareholders equity equals to retained earnings plus common stock plus, for example, preferred stock. There are additional paid in capital. There are a lot of sort of things that are reported under shareholders equity. But for this course, as an introductory course, the most important part is this retained earnings plus common stock. Okay, so think of it as shareholders equity equals retained earnings plus common stock plus some other items. Okay. Now, under retained earnings, you report a net income or net loss minus dividends. Okay, dividends. Okay, so if I write this number one equation into a full form, it will equal to assets equals to liability plus net income minus dividends plus common stock plus all sort of other items. Okay, so you need to be able to play around with this equation because there are going to be a lot of questions asking what's the amount of dividend given this equation. Okay, what's the amount of common stock given all this sort of accounting items? That's going to be the focus, and then that's going to be heavily concentrated or focused on the midterm as well as the quiz. Okay. Now, if I expand this equation even further, net income equals revenues minus expenses. Okay. So in another full form, that equation becomes liabilities plus revenues minus expenses minus dividends plus common stock plus other items. Okay, so at this point you need to be able to follow, or you need to be able to keep track of the flow of these equations. Again, we're starting with the giant or the the whole equation, which is this, but we break down shareholders' equity into more items, and we break down this retained earnings into more items, and we again break down this net income into more items. So we play around with these equations to trick students, basically. When we give out the midterm and we quiz students on this particular.
So let me ask you on, I read through chapter 2, I did the homework already.
Good.
Can you point, since you're giving the different variations on the equation, can you point to some problems which would focus on some of these variations? Because we have the solutions manual and we have everything, but if there are some particular ones you want to put in your email and point out that you think would be helpful to work through, that would be good.
Whoa, that's something that I haven't prepared. Let me quickly look at whether we have any practice problems.
I mean, look, they're in the book, but I don't want to, you could spend 10 hours on going through every single problem, or maybe you could give us about an hour of specific problems you think would be most helpful.
Okay.
The equation.
I mean, at this point, I haven't prepared a problem set, so I can give an example, just a simple example, in order to help understand. So let's say, whoa.
No, I mean, pull it out of the book, not right this second. I mean, email us tomorrow. And
okay.
For
I can definitely do that.
Students to have a couple of relevant examples from the book with the solution in the back.
Okay. Let me just write down here. Email students example problem. Okay. Any other questions?
Yeah, just a question. Is there in the stockholders' equity? It's not here, but what is contributed capital? Because sometimes I've seen something like that in some equations where they have contributed capital, but it's not here.
Contributed capital. I have to look into specifically what you're, but whenever we talk about contributed capital, so capital, you can think of it as money or cash. So when we say contributed capital, it could be related, something related to investors buying common stock of a company. So that investment will go into company's bank balance. So that's one form of a contributed capital. But again, I have to look into what you are actually specifically referring to in order to answer to your question.
Cool. So, thank you.
No problem. So there is a question. So what does PS stand for? So I'm sorry if I'm using a lot of acronyms, but so whenever I use PS, so that refers to a preferred stock. Okay, so we have a common stock, we have preferred stock. So there are different types of stocks that are outstanding. Okay, it's good. Any other questions? Okay, so another thing that I wanted to do before we get into the actual chapter 2 materials is to go over individual accounting line items. So we talked about cash. So everyone understands what cash is. So what about accounts receivable? I'll refrain from using acronyms as a starter. So accounts receivables. So where I use AR. So this accounting item refers to a money that you will receive by selling products or providing services. So for example, let's say, like I said previously, Starbucks is my favorite store. So let's say Starbucks sells coffee for $3. Okay. So at the point of the sale, the company will report an increase, okay, an increase in revenue because the Starbucks is providing service to a customer, so that's revenue. And at the same time, so given that the customer uses credit card, so at the same time, Starbucks will report an increase in accounts receivables by $3. by $3. Okay, so accounting receivable, again, it's the money that the company will receive soon from a customer, from a vendor, any sort of the money that you are going to receive from a third outside party. Then we use this accounting item called accounts receivable. Okay, another item that I want to talk about is inventory. So inventory, very easy. So for example, for Apple company, iPhones are inventory. For Walmart, it's going to be all sort of things like computers, food, all these things are going to be reported under inventory items. So something that you sell to customers in exchange for money. So that's inventory. And another thing is prepaid. Prepaid expenses. Oh, by the way, all these accounting items that I've been just describing are assets. So let me just put down this, assets. So I explained this last time. When we say assets, it's the benefit that the company will get from selling products or providing services. So accounts receivable, you're getting money from a customer, so that's a benefit. Inventory is an asset because by selling inventory, you're getting money from a customer. So that's an asset. What about prepaid expenses? Now, change that. So prepaid expenses. About 5 minutes ago, I said expenses are usually reported under income statement. So salaries expenses, postage expenses, interest expenses. So usually when we report expenses, it is reported under income statement, but prepaid expenses are a different, in different world, basically. So maybe it's easier to provide an example. I don't know why it keeps changing. So example, insurance, okay? I don't know how many of you are driving cars, but in order to drive a car in the United States, you have to buy an insurance, right? Now, in my case, I have Geico, okay? I have Geico for 6 months. I am paying about $480, okay? Upfront. So basically you are paying $480 to Geico for the coverage of my vehicles in the next 6 months, okay? So basically, instead of paying after you are being covered for automobiles, you are paying upfront to a Geico in order to have my car covered by Geico insurance company. So if you're paying something in advance, you are going to report that under prepaid expenses. So it could be prepaid insurance or prepaid rent. Now, rent is very similar. If you're renting an apartment, you are paying 1 month's rent in advance, right? Usually. So that's, even though you're not living in that apartment, you are. So how do I explain this? So basically you are paying the rent upfront for the services to be provided by the landlord for the next 30 days. So again, that's another type of paying something in advance to a vendor or to a landlord or to an insurance company. So that is an asset. Okay, so that's something that a lot of students are confused about in the beginning of the accounting course. But again, whenever we say prepaid expenses, prepaid insurance, prepaid rent, it will be reported under an asset. So that means prepaid expenses is an asset reported under a balance sheet. Okay, any questions or any confusions you guys have? Okay, so that's good.
Professor, I'm so sorry. Are the prepaid expenses only booked on accrual basis? Basically, if we're on cash basis, there's no prepaid expenses, right?
Yeah. So everything that we are learning is follows the accrual basis of accounting, not cash basis. Okay. Any other questions?
Thank you.
No problem. Any other questions? Good. Okay. So these are some of the items that you have to understand, utilize, or memorize, okay, as a beginner of accounting field. Let's move on to liabilities, okay? I said liabilities is something that the company should report whenever the company has an obligation to provide service, obligation to pay back the amount that you owe to a bank, for example. So accounts payable, okay? I don't want to use acronym again. So accounts, what's going on? Accounts payables. So these are liabilities. So something you're paying back, of course, is a liability. So for example, again, if you are at Starbucks, now you are a customer. Think of it as you are a customer. So you go to Starbucks and buy coffee using credit card. Okay, credit card. By using a credit card, you are incurring an accounts payable. You owe technically to a bank, but you owe to a Starbucks for $3 of coffee. That is to be paid in the next cycle, okay? So that's why accounts payable is reported in the liabilities. Now another item is notes, okay? Notes payable. So whenever we say notes, it has something to do with borrowing money from bank, okay? So you go to a bank and take out a loan, for example, you report that amount of the loan under notes payable, okay? There are other types, so bonds payable. So there are a lot of items that you can borrow money. So you can go to bank or you can buy bonds from a company, but you don't have to really understand what bonds are for now, okay? But just to know that these payables fall under liabilities section, okay? Another thing that I want to talk about is not really. Any questions with respect to assets, liabilities? Okay. No. Okay. Last thing is shareholders' equity. Like I said previously, under shareholders' equity, you have common stock. So basically, I explained this. So if you want to buy a Tesla stock, since last time the stock price plummeted, for example, unfortunately. But anyways, so whenever you buy a stock for a company, let's say Tesla stock by $300, that money will go into Tesla's bank statement, bank balance, okay? So that's gonna be reported under shareholders' equity. You have preferred stock. Now, do I wanna explain the difference? Not really. Common stock, preferred stock, additional paid in capital. You don't have to know this for now, okay? But this is one item that's reported in the shareholders' equity. You have retained earnings, also other items, okay? So like I said previously, what you need to do as a beginner in the accounting profession or as a beginner who are learning this accounting in the introductory course is to be able to identify, understand, and apply and memorize all sort of accounting items that are going to come up as you go forward with chapter 2, chapter 3, and chapter 4. So if you're confused with anything that I just explained here, you will have hard time understanding what I'm lecturing on. So at this point, try to go to, go to your textbook. I'm sure the textbook has what we usually call the chart of accounts. So basically, it lists all the accounting items that you have to know for this particular course in order to write journal entries, okay? So look for this chart of accounts, all the list of accounting line items that you have to know, okay? Now, so all these were balance sheet items. What about income statement items? Let's briefly talk about some income statement items. So we have sales revenue. Okay, so whenever a company makes sales, let's say Apple company is selling iPhones, you're going to report sales revenue. There are other types of revenue, service revenue. Okay, So if you are like a janitor or you kind of lend more, you're providing a service for a customer. So instead of reporting sales revenue, you are going to record it under service revenue, okay? Another item that you have to know is this, COGS, or cost of goods sold, okay? So as an example, let's say, using Tesla example, Model 3, okay, Model 3. This car cost about $50,000. So by selling Model 3 to customers at the amount of $50,000, there are going to be costs to manufacture the car. Okay, so for example, there are going to be labor expenses, there are going to be like an electricity, there are going to be like a sales representative expenses who are making sales for Model 3. So you report all this sales related expenses under this COGS, or cost of goods sold. Okay, something that you have to know for this course. What about operating expenses? So whenever we say operating expenses, we are referring to all these expenses related to operating a company. So let's say if you're a Tesla, there are going to be advertising expenses. There are going to be like a sales reps, what do you call it? The incentives or the commissions that you're paying to the sales rep. Okay, so for example, the most important item is this selling, general, and admin expenses, okay? Or we call it SG&A, okay? So this SG&A expense is like a typical expense that you report under operating expenses, okay? There's an interest expenses, there's a tax expenses, but it's very easy. I mean, if you're paying for interest, you're going to report under interest expenses. If you're paying for tax, you're going to be recording tax expenses. Now, another thing that you might not be familiar with is this gain or loss, okay? So for example, gain on sale of an equipment, for example, equipment, okay? So let's say you're a company and you sell your equipment that you owned for the past 3 years, for example. If you sell that equipment, there are going to be gain or loss depending on how much you're going to sell your equipment at to a third party. So for example, let's say your value of an equipment is $30, but you sold that equipment at, for example, $27, okay? So the value is $30, but you're selling your equipment at $27, so you have a loss of $3, okay? But let's say if you're selling your equipment at $33, then you're going to be recording a gain of $3 because the value is 30, but you're selling the equipment at 33, so you're making some money out of selling your equipment. So you report the gain.
Basis or value? Like,
What was that?
Is it basis or value? Because value to me means market.
Now, what I'm referring here, value, is the book value.
Book value, okay.
Yeah, the amount that you report under your books, basically.
Got it, okay.
Yeah, but you don't have to know book value or fair value or carrying value, salary. We're gonna talk about that in chapter 6, I guess. Just as like a brief idea, let's say the value is 30, but you're selling it at 27 or 33, you're going to report a loss or gain depending on the amount that you're selling it, okay? Any other questions? Okay, So these are some of the things that I want you to touch upon or discuss or explain before we get into the actual concrete materials for chapter 2, okay? So for chapter 2, we're going to be learning how companies record each types of transactions that I just explained, for the past 45 minutes, okay? Let me just make it here. Okay. So for chapter 2, we're going to be learning how we measure the accounting activities of a business. So that's when we say measure, we say we record transactions, and we need to be able to communicate the measurements to external parties for decision making. So in other words, we're going to learn how we prepare financial statements, okay? So identify the basic steps in measuring external transactions. So these are the steps that you need to do in order to write journal entries and in order to prepare a financial statement and in order to prepare a trial balance that you see at the end of the day. But don't worry about the trial balance for now, but let's go through each individual steps, okay? So for step 1, we use this source document. So when we say source documents, we're typically referring to like an invoice, okay? Invoice or a receipt, okay? So within the invoice, there are going to be information about the vendor information, date of a transaction, what was the product that you're selling or you are buying from a vendor, the payment terms, okay, whether you're paying using cash or whether you're paying using accounts payable. So these payment details will be will be included in the invoice. So for step 1, we are going to provide this information for you to be able to write journal entries, okay? So from looking into the information that are contained in invoice, you have the first step you have to do is to come up with what accounting item that you are going to use, okay? So for example, let's say the invoice says the company is buying inventory. Well, it's not going to say inventory, let's say iPhone, okay? Then, in that case, instantaneously, you have to come up with an accounting item that is inventory, okay? And then depending on the payment terms, you have to instantly come up with whether I'm going to be using cash in order to write journal entry or accounts payable to pay for that inventory, okay? So that's step 1, okay? Step 2 is analyze the impact of the transaction on the accounting equation. So basically what that step 2 indicates is that you are going to be writing journal entry, and that will tell you whether there was an increase in asset or decrease in asset, increase in liability, decrease in liability, or increase in shareholders' equity, whatever, decrease in shareholders' equity, okay? After you write journal entry, make sure that this equation holds, okay? Excuse me. If you increase an asset by 30, okay, you will, okay, have to be able to find out whether the liability was increased by 30 or whether there was a shareholders' equity increase by 30, or it could be the case that the asset decreased by 30 in order to make this equation hold, okay? So if this equation does not hold after you write journal entry, there is a problem with your journal entry, okay? So that's step 2. For step 3, assess whether the transaction results in a debit or credit to account balances. So now we get to what I call a beauty of accounting. Okay, what I mean by beauty of accounting is this debit and credit system. Now, if you don't know accounting, if you're just a people in the world, whenever we report an income, whenever you report an increase, you're just gonna use plus sign here. And then whenever you report like a spending, expenses, or for giving money, you're going to be using this negative sign minus, okay? So let's say, for example, I received money by $30, but I spend about $5 buying an ice cream, for example. So at the end of the year, I have $25 left for spending. Okay, that's what usually do people. That's what people usually do in the world. But in accounting field, we don't do that. This is not the system that we use. Okay, so going forward, don't think of it as this way, but think of it as a debit and credit system. Now, I will prepare a table for you, okay, in order to help you understand what debits and credits are. So we have assets equals liability plus shareholders equity, and we have a table here. So let's say we have an increase and decrease, okay? So this table is very important. You have to memorize this. I cannot emphasize more than other areas of accounting field. This table is going to be something that you will be using for the rest of your accounting career, okay? So when you report an increase in assets, we call it debit on asset, okay? So in other words, when we want to increase an asset, we debit on asset, okay? When assets decrease, we say we credit on assets, okay? Now, on the flip side, when we report an increase in liability, we credit the liability. I don't know why it is doing this. We credit the liability. When we decrease the liability, we debit that liability. Since liabilities and shareholders are on the same side, when we increase the shareholders' equity, we credit the shareholders' equity. When we decrease the shareholders' equity, we debit shareholders' equity, okay? So from now on, I'm not going to say that we report an increase in asset. I'm going to say simply we debit an asset, okay? Or for example, if we report a decrease in liability, I'm going to say we're going to debit the liability instead of saying a decrease in liability, okay? So these are the terms that we use in accounting field to indicate an increase or a decrease depending on the accounting items that you're using, okay? Any questions before we move on?
Just one question. In the shareholders' equity portion of retained earnings, which is revenues minus expenses, right? Isn't it an expense? You debit an expense and then you credit. Okay, cool.
Yeah. So that was something that I'm going to go for. So previously, about 40 minutes ago, we talked about breaking down shareholders' equity, right? So under shareholders' equity, we have retained earnings plus common stock. Okay. So following this, when we want to increase common stock, I'm going to credit common stock. So I'm going to use this arrow to indicate this. Okay. Okay. And similar, when we want to increase retained earning, we're going to credit retained earning. Okay. decrease retained earnings, we're going to debit retained earnings, common stock, debit common stock, okay? Now going even further as a variation, this retained earnings, we can break down even further. So that's net income minus dividends, okay? So when we increase or decrease, okay? So when we increase net income, that's credit, okay? When we decrease net income, that's debit, okay? Same goes here. So when we credit dividends, that means we're increasing dividends. When we are decreasing dividends, we're debiting dividends, okay? Now we're gonna go even further down, okay? So net income, that's going to be revenue minus expenses, So let me go down even further. So we have an increase and decrease. So following the same scheme, when we increase revenue, that means we're crediting revenue. When we decrease revenue, we're debiting revenue, okay? When we're increasing expenses, we're going to credit revenues and increase this, okay? When we're decreasing expenses, we're debiting expenses, okay? So again, it looks very complicated, okay? But as long as you are able to follow through these equations, okay, you are going to be able to indicate whether we are crediting or debiting this individual accounting line items. Any questions? Okay, okay, good. So I'm sure you're confused with this debit and credit system, but as you practice more and more with practice problems, you're going to be easily able to do this. But for now, I understand it's very confusing. A lot of students are confused about whether to use debit for the particular transaction or whether to use credit for the particular transaction, but I will provide an example soon, okay? So that was step 3. Step 4, you're going to record the transaction in a journal using debits and credits. So after you determine whether or not you are going to use debit and credits, then afterwards for step 4, you're going to record a journal entry. So journal entry. Oh, it looks ugly, but it doesn't matter, okay? So for a journal entry, this is the, there are so many ways that you record a journal entry, but the easiest way to record a journal entry is to report a debit accounting item and then credit accounting item in a separate column. So what I mean by separate column is this. So in the first line, you usually report debit items. For example, you debit cash by $20, okay? So in the first line, you usually report the debit accounting items. In the next line, okay, you're going to indent a little bit in order to indicate that you're reporting a credit, okay? So let's say inventory for $20. Okay, so for this particular transaction, what the company is actually doing is that the company is selling an inventory in exchange for cash. Okay, so let me just graphically illustrate you what's going on. So you are a company, okay? So you're going to selling your inventory to a customer, okay? So by selling an inventory, the level of an inventory will decrease, okay? And now, so that inventory will decrease. In exchange, you are receiving cash from a customer, okay? So cash will increase by $20, okay? So far, so good, right? So we know that inventory is an asset item. We know that cash is an asset item, okay? So when we have an increase in asset, we report debit, okay? Or simply DR. I use DR. A lot of accounting professors actually use DR to indicate that it's a debit item. So when we increase an asset, which was cash, okay, you report debit cash by $20. And by selling that inventory to a customer, there was a decrease in assets. So that's a credit, or CR, to refer to credit by inventory, okay, for $20. So this is the journal entry for the particular transaction. So when company sells an inventory in exchange for cash, cash will increase because you're receiving a cash from a customer, but you're also decreasing inventory because you're selling that inventory to a customer. And this is the journal entry you're going to be recording in the accounting department. Okay. Any questions with respect to journal entry?
Professor.
Yeah.
So when we do the journal entry, those terms are always going to be balance sheet terms?
Oh,
right?
no, it could be income statement items, the accounting items. So I'll show an example, for example. Okay. So let's use another example, Starbucks. Okay, Starbucks. So you have to think of it as, for this, you have to think of it as you are a Starbucks. You're not a customer, you are a Starbucks. So let's say Starbucks sells coffee to a customer for $3. Okay. So what's happening here? Let's say, for example, Starbucks sells coffee, okay, for $3, okay, in exchange for cash. For cash, $3. Okay, so let's start with cash. So cash is easy. So it's an asset item. So asset will increase by $3. Okay, that's easy, right? So let's go to selling coffee. So when Starbucks sells coffee to a customer, so that's a revenue, right? So you're going to be recording revenue by $3. Okay. Now revenue falls under retained earnings, which falls under shareholders' equity. Okay. Now when we increase shareholders' equity, we said we credit. Okay. So as a journal entry here, when we experience an increase in assets, that's a debit by cash for $3. Okay. For selling coffee, you are going to report credit sales revenue by $3. Okay. So this is the journal entry. So whenever you're preparing or reporting a journal entry, you don't have to use only balance sheet items. There are going to be items fall under income statement items. But this was an example here.
Professor?
Yeah.
Why you didn't use sales revenue in the first example with an inventory?
Sales revenue here. So it depends on what the focus is. So here. So similar to inventory, in order to sell coffee, there are going to be, let me just go up. There are going to be costs of coffee, right? So there are going to be like a purchase price for the coffee. So let's say purchase price is $1. Okay. So in this Starbucks case, coffee is sort of treated as an inventory. So let's say for Walmart, you have an inventory. For laptops, for Starbucks, an inventory will be usually related to the coffee. Okay. So the cost of coffee. So you're going to be reporting the cost of goods sold by $1, coffee, or that's inventory for $1. Okay. So for one particular transaction, there could be multiple journal entries that we're going to be covering going forward. But for now, what you have to know is that there should be a debit accounting item, credit accounting item, and the numbers should balance between the debit and credit. Okay. Any other questions? Okay, I think we're good. So this was an example used from a Starbucks perspective. Okay, so let me just flip to a customer side. The customer side. Okay, so I can't see. So let's say a customer goes to Starbucks and buy coffee for $3. Okay, so now you're a customer, not Starbucks. So at the point of the purchase, what you're going to be recording is that cash will decrease by $3. Okay. Now, another thing that is going to be reported is usually expenses. So since you are buying coffee, okay, that's expenses. Expenses will increase by $3. Okay, so cash is an asset item. When assets decrease, we credit cash. Okay, when we have an increase in expenses, so that's very confusing. So expenses fall under shareholders' equity. Okay, but since expenses are the negative item, we debit expenses. Okay, so as a journal entry, what you're going to be recording is coffee expenses for $3 and cash will decrease by $3. And you can also say, you know, this debit coffee expense $3, credit cash $3. Okay, so for the same transaction, if the journal entries will differ based on what perspective you're going to be recording. If you're Starbucks, you're going to be recording revenues. If you are a customer, you are going to be recording expenses. Okay. So this is on one example of a journal entry that you're going to be learning throughout the semester. Okay. Any questions before we move on? Okay, I think we're good. So step 5. Step 5 is posting a transaction to the general ledger. So when we say general ledger, it's basically, you can think of general ledger as a summary or an aggregate of all the transactions for the particular accounting item. So for journal entries, the focus is on the transaction. So number 1, there was a transaction. So this is the journal entry. There we are recording. For number 2 transaction, this was the transactions and this was the journal entry. And periodically we prepare a general ledger. So for particular accounting items, let's say we have revenues, expenses. So this is basically the general ledger. So general ledger aggregates or summarizes what happened for that particular for the entire transactions that's related to cash. So for example, number 1 transaction, we increased cash by $3. So under cash, we are going to increase cash by $3 based on number 1 transaction. Based on number 2 transaction, we reported credit cash or a decrease in cash. So we report a credit cash under number 2 transaction. So at the end of the day, we report 0 change with respect to the cash transaction. Okay, so this is a general ledger account for cash, and there could be multiple general ledgers for revenues, accounts receivables, accounts payable, notes payables, or plans or factories. So again, general ledgers basically summarize what has happened for that particular accounting item from all sorts of business transactions. Okay, now this is usually called a T account. So in accounting, we use T accounts all the time. So first we draw T here, or table, whatever, however you call it. On the left side, we always use for debits, okay? So debits. And on the right side, we always report items under credit, okay? So whenever you report debits, you report the number on the left side. Whenever you report a credit, you report on the right side of the T to indicate a credit business transaction, okay? Any questions for the general ledger? Okay, I think we're good. And last step is step 6, prepare a trial balance. So basically trial balance is this. It's again all T, okay? It's a long T table here. It is going to say trial balance. So what trial balance is doing is that whether all the debit items and credit items balance or equal to each other. So we reported cash debit or cash credit. We also reported, if you remember, we reported revenue here, credit. We also reported debit expenses. So you report debits and credits. Revenue. This is expenses. This is revenue. Okay. So what we're doing for trial balance is to make sure that all the debits that we reported for journal entries throughout the period equals to the sum of all the credits that we reported for journal entries. This is one way, another way to make sure that your journal entries are correct. So again, going back to the original accounting equation, whenever you prepare journal entries, these equations should hold all the time, okay? Also, we have debits and credits. These two, okay, the sum of all the debits should equal to the sum of all the credits, okay? Now, this is called a dual effect, okay? Dual effect. When you are reporting a debit, there should be another one that's reporting credit, okay? Going back to the original transaction here, whenever you report a debit, you are going to report a credit by the exact same amount, okay? And that's why the sum of all the debits should equal to the sum of all the credits. And that's the point of having a trial balance. Any questions so far? Okay. Okay, no questions. So I've just covered a lot of things, okay? So first one was the accounting equation, and we break down shareholders' equity into the retained earnings and common stock. We also broke down retained earnings into net income. So again, you have to know that variations with respect to the accounting items. Also, we talked about debits and credits. Let me just go up a little bit. So where's the table? I forgot the table. There you go. So table this. So when we increase assets, we debit asset. When we decrease assets, we credit asset. So again, you have to memorize this table, okay, in order to move forward. And we talked about journal entries and how to prepare or record journal entries for each particular business transactions, okay? That's the whole goal of chapter 2, okay? For the rest of chapter 2, chapter 3, and going forward, okay? Any questions? Okay, so I have to make one disclaimer here, okay? Very important, the disclaimer, okay? Even though I am teaching basic accounting and how to record a journal entry, don't take my word as a rule, okay? I don't have that. So basically there are going to be standards, okay? There are standards that you follow in order to record journal entries. So again, so let's say cash, $3, inventory, $3, debits and credits. Although this transaction is very simple, okay, this is not a rule, okay? This is a standard, or to be more accurate, we call it accounting principles, okay? This is a principle that I'm teaching you. This is not a rule. There are going to be some other interpretations with respect to the business transaction, okay? So depending on how you interpret that particular business transaction, there could be variations with respect to how you record a journal entry, okay? So let me just pull up this here, okay? So I use the example all the time. So this is Tesla financial statement, or Tesla's 10K. So one part of the financial statement talks about the accounting principles. Here. So sometimes companies disclose that there are changes in accounting principles. So for the particular 2020 financial statement, Tesla company reported that there is a new revenue standard or new revenue recognition principles, okay? So when you change the standard, when you change the principles, there are going to be changes with respect to how you record the business transactions, okay? And this happens all the time. So what I'm trying to say here is that even though I am teaching you journal entries, even though I'm teaching you how to prepare a journal entry based on the transaction, there are going to be always a possibility that the accounting principles or accounting standards change, and that will result in the change in how you record a journal entry, okay? So take my lesson or take my lecture with grains of salt, okay? There could be a potential changes with respect to how you apply the accounting principles, okay? Any questions so far? Okay, so I want you to provide you more details with respect to the change in revenue recognition principles. So since we are MBA, not undergrads, so according to Tesla, we recognize revenue on automated sales upon delivery to the customer. So I want to talk about this. So when do you, let me just minimize this. When do you report revenues? Okay, let me just give you an example here. Revenue. Let's say you are Tesla, okay, and a customer comes to the dealer shop and then signs a contract. Okay. At the point of the signing, Tesla company does not report revenue, even though the customer signs the contracts. Okay, that's not the timing when Tesla reports a revenue. According to the Tesla's disclosures, Tesla only recognizes revenue upon the delivery of a vehicle to a customer. So when customer signs a contract, you do not report a revenue. Okay, or let's say another example, when customer pays cash, let's say down payments, okay? So whenever you go to a dealer shop, you usually pay down payments, okay? When customer pays down payment, does Tesla record a revenue? The answer is no, okay? At the point of customers paying down payment, we do not report a revenue. At the point of signing a contract, we do not report the revenue. We only report revenue upon the delivery of the vehicle, okay? At that point of the delivery, then the Tesla reports revenue. Okay, that's the accounting principle that the Tesla company is following. Okay, so again, this is not a rule, this is an accounting principle. Depending on how companies interpret the accounting principle, there could be different journal entries, different timing with respect to recording journal entries. Okay, now according to Tesla, we reduce the transaction price and record a sales return reserve against revenue. So sometimes customer return an item for whatever reasons, then the company reports a sales return. I mean, that's pretty much straightforward. Let me go down a little bit. Now, this is more interesting stuff. So, vehicle sales to leasing partners. So let me just use some real world examples. I do not know how many people have leased a car before. So let's say, let's say you go to Mercedes. I think this is how Mercedes emblem looks like. Okay. Let me just change that. Mercedes. To lease a car, for example, GLE, okay, for $55,000. Okay, so when you are leasing a car, you are not leasing from Mercedes-Benz, okay? You're actually leasing from Mercedes-Benz financials, okay? There is an intermediary that's getting involved with the leasing of a vehicle from Mercedes-Benz. So this is usually how leasing works, okay? So if you did not know about leasing, so Mercedes financials usually the one who are leasing a car to you, not the Mercedes-Benz manufacturing company. Same goes to BMW, same goes to Audi, same goes to Honda, Lexus. It's usually the financials that are leasing the cars to a customer. Now, so in this case, vehicle sales to leasing partners. So according to Tesla, when Tesla company sells a car to a leasing partner, for example, Mercedes-Benz financials, companies, for this transaction, the company is reporting an interest-bearing collateralized borrowings. Now, it sounds very fancy, but let me just draw what's happening here. So you have Mercedes, and you are selling a car to a leasing partner. Okay, partner. Okay, it looks like this Mercedes-Benz is selling a car to a leasing partner. If you sell something, it looks like at the face value, making a revenue from selling a vehicle to a leasing partner. But what actually happened prior to January 1st, 2019, the transaction was regarded as an interest-bearing collateralized borrowing. So what that means is that instead of reporting revenues, basically company is borrowing money, cash, borrowing money, cash from leasing partner, okay? But instead you are incurring a liability with vehicle as a backup or collateral. This is what they mean. So let's say if Mercedes-Benz cannot pay back money to a leasing partner, this vehicle will be as a guarantee to pay back for the money that you borrow from the leasing partner. So it looks very weird from general public's perspectives. So even though Mercedes-Benz is selling a car to a leasing partner, according to accounting, it is considered as a borrowing money from leasing partner. and you're actually incurring a liability with vehicles as collaterals. Okay, that was what's happening prior to 2019. But after the accounting principle changed afterwards, the company is just reporting on operating needs, just like us making sales to a customer, operating cash activities. Okay, so again, what I'm trying to say here is the fact that depending on how you interpret the accounting principle, the journal entry that you're reporting may look very different, okay? So prior to the change in accounting principles in 2019, this Tesla company was actually reporting a liability as if you're borrowing money from leasing partner, even though the transaction is basically selling a car to a leasing partner. But after 2019, the company is actually leasing a vehicle to a leasing partner and reported under operating leases. Okay, so this is what I'm trying to portray here. Okay, so as an introductory accounting course, I didn't have to go into that detail, but what I'm trying to say here is that depending on how you interpret the accounting principles, not rules, there could be variations with respect to how you apply the accounting principles and how you record the journal entry for each business transaction. Okay, so any questions before we move on?
I got a quick question on
Okay.
this. Maybe it's on the topic, maybe it's a little different from the point that you're trying to make, but just by looking at this, right, the transaction where Mercedes is actually here borrowing rather than selling the car. So when do we recognize the revenue?
For this example?
By Mercedes, yes.
There is no revenue. So again, so even though it says the vehicle is sold to a leasing partner, in accounting, how the Tesla interpreted the accounting principle was that this is not actually a sale of a vehicle. It's actually, it's like similar to a loan. You're borrowing money from a leasing partner. So you do not report it in revenue. And that's interesting to you, right? But that's how the company reported this transaction according to this ASC 840 lease accounting principle. And that's what I'm trying to say here. Depending on how you interpret or how you apply the accounting principles, the journal entry that you're going to be recording might look very different from what you actually see right here, vehicle sales. Okay, but this is something that's very advanced that involves a lot of lawyers and attorneys interpreting this accounting principles. But I just wanted to provide you an example that how you interpret your accounting principles may affect how you record a journal entry. Okay. Any other questions?
Professor, is there any reason why are they doing this? Because if they're doing this, they just reduce the sales revenue, right?
Yeah, not technically reducing a revenue, but you're just not recording a revenue. And then your question was, why does the company do it? I mean, what are the reasons? There is no reason, okay? This is how the company interpreted the accounting principles. I mean, you're saying that the companies might be committing fraud or the company might be misleading investors, but that's not the case. This is just how company interpreted the accounting principles, and that's why the company reported journal entry as if the company is borrowing money, not making a sale to a leasing partner. And there's no like a hidden motives with respect to how the company reports this.
And the way they doing this applies a gap too?
No, this is GAAP. What we're talking about is GAAP.
Okay.
Yeah, the US GAAP. Okay. And I just want to point out that, so your question was, what are the reasons? Okay. Why does the company do it? One is that's how the company is interpreted. And another one is this, auditors. Okay. this is where auditors comes in. At the end of the year, when companies close the book, auditors comes in and they review how companies apply the accounting principles. And they are the ones, like an opinion to express whether the way the company is applying these accounting principles are correct or not, or are they misleading the investors? Are they correctly applying the accounting principles? So that's why they are adding this credibility, okay? Credibility to a financial statement with respect to whether this journal and whether the way the company recording journal entries are credibly applied based on the accounting principles. Okay.
Professor,
So,
Yeah.
I'm sorry.
Go ahead.
Katerina, go ahead, Katerina.
Manu, I had a question about
Sure.
10K reports, what we have under course documents. When we preparing our presentations, do we need to use these reports or do we need to use new ones? You know, because every quarter they change.
So your question is, what do you use for presentation?
Yeah, like, you know, you have 4 Ks for different companies, right?
Uh-huh.
Course documents.
Uh-huh.
And for our presentation, like, you know, every student would present, I mean, who volunteer to present, right? Do we need to use this particular 10 case that you saved, or do we need to use new reports? Because, for example, in October, right, in the end of quarter, we would have a new reports.
I see. I mean, you can use, I mean, again, there is no limit with respect to how you present. I mean, the whole point of having students present is to evaluate whether they understand the accounting principles, the lessons that we learned during the class, how you can apply them for your presentation. So there's no limit with respect to whether students are confined or limited with the four financial statement that are posted on Blackboard. You can always use a new or updated financial statements, or you can use some other accounting information in your presentation. There is no limit, but there's no limit of scopes of your presentation. I welcome your institutional background knowledge. I welcome anything that you can talk about with respect to accounting during your 10-minute presentation.
Okay, thank you.
No problem. And there was another question?
Yes, my question in regards to the, I guess, the previous accounting rule that we discussed prior to January 1st, 2019. How would you book that entry in terms of credits and debits? So are you increasing liability?
So this is just a brief discussion, but based on the reading, my impression will be this. So since the company is receiving cash, you are going to be debiting cash by some amount, okay? And you're going to be, let me just change that, crediting liability. I don't know the exact accounting item because I don't work for Tesla, but some liability account by the dollar amount. This is what we're going to be recording.
Thank you.
Any other questions?
And then I guess a quick question would be that when the leasing contract actually ends, what the liability has to be reversed out, and then what happens then?
So basically, again, don't think of it as making sales to a leasing partner. Think of it as borrowing money from a bank. So you have a liability, let's say year 2020, 2022, you're going to debit liability, okay, by some amount. You're going to credit cash. So you're paying back money and you're going to be decreasing liability by debiting the liability.
Does the fact that it's a related party transaction cause any problems? Because are those the credit side, you know, they're affiliated entities. So is there an issue there?
So again, you just use the term or word problem, and I say this is not a problem. This is how the company reported it. Is it because it's affiliated? Is it because it's a leasing partners? Could be. But again, this financial statement or this 10K is a product of so many professionals, including accounting professionals, law professionals who have a good knowledge about the new rules. So based on their discussion, they're saying that if Tesla company sells a vehicle to a leasing partner, this is how we're going to treat
Well,
the transaction.
What leasing partner, is that a subsidiary? Are they both subsidiaries of a parent corp?
Again, I don't work for Tesla. That's how they define leasing partners. My understanding is these financials that are involved as an intermediary. But again, with respect to the definition of leasing partners, you have to talk to the lawyers or attorneys, outside counsels working for Tesla.
All right.
Yeah. So there are a lot of questions arising from this. But again, the point is the fact that what I'm teaching you from this course is not a rule. There could be changes in rules, or there could be different interpretations with respect to the transaction. I just wanted to provide an example using the real world financial statement that even though it may look like transaction A, in accounting, it may look like transaction B, whole different types of story. Okay, any other questions? Okay, I think it's a great time to take a break since we covered a lot of things. So it's 7:41 now, so we're gonna take about 20-minute break and we're gonna resume at 8 o'clock, okay? So 20-minute break.